Hi, I'm Christine Giordano with Markets Group, and I'm here with Chief Investment Officer Larry Krummen. He is heading Missouri DOT and Patrol Retirement System. That's a $4.5 billion system. The interesting thing about Larry is that he has scored in the top 1% of funds in the country for the past 1, 3, 5, 10, and 20 years. Congratulations, Larry.
Thanks, Christine.
I'd really love to learn how you did this, what you set up as the very first CIO that MDOT and Patrol System ever had, and go into this. You were about to win a Hall of Fame award from Markets Group at our Kansas City, Missouri event. You've been nominated multiple times for the award, but I'm sure everyone is scratching their heads going, how did he do it? Larry, as the very first CIO, what did you have to set up in order to do it right?
Yeah, first off, thanks for the award, and certainly it's a pleasure working with you and getting to know your team. It's been a long road. It really has. And it's a good story to tell. I think we could be helpful for a lot of other public funds that are going through similar challenges with funding and returns, et cetera. But it took a lot of baby steps. It's nothing that you can fix overnight. When we came here, I started in 2003. Our system was created in 1955. It took us 48 years to get to the point where we were in 2003. You can't reverse that course overnight. You've got to set a lot of long-term policies in place and just start slowly whittling away at the challenges that you've got and the structure that you need to put in place to really turn things around. So happy to go into more and more detail with those, but it all started with really board governance, first and foremost. We established new investment policies. The investment policy was really the first of what ultimately became more encompassing board governance policies. We added systems, we added resources, we added staff, we completely overhauled the investment portfolio. Secondly, and probably more importantly, we kind of fixed the funding problem that a lot of our pensions have. There's two ways that a pension fund can get funds into the program. One is contributions, and the other is through investment performance. So while we've done a great job in my mind of investing the portfolio in a way that's been beneficial, the other side of that is a lot harder, and that's to get the employers to put more money into these funds. It's the contribution side. And shortly after the financial crisis, we really went through some austerity measures, buttoned that down to the tune where for many, many years, our employers were paying 58 cents on the dollar to fund the contribution rates that the actuarial community was recommending that we fund to kind of fix the funding issue. So it's been a long run. It's been a painful road at times, but it's been a pretty good turnaround story that I'm proud to be a part of.
Yes. So, just as an overview, you've quadrupled the size of the fund as far as the AUM, or led that, scoring in the top 1%. You've also made some very interesting timber investments, some private equity investments that have scored pretty well. Your fixed income investments have become your darling. We'll go into all of this, but let's start with the turnaround kid story. Everyone loves to hear these stories, but you know, obviously you had come to this fund with some prior experience from Missouri State Treasurer's office, correct? And then what?
Well, I really didn't have any other public fund experience when I started here. When I worked for the treasurer staffed the board the treasurer sits on the board at Mosher's, the bigger state employee retirement system that has every other state agency besides the Missouri DOT and the Missouri State Highway Patrol. So I cut my teeth with the treasurer's office in staffing that role in her capacity as a board member for Mosher's. And really, I met a mentor of mine over at Mosher's for many, many years. Mosher's was the gold standard for investment returns across the country. They were one of the best performing funds in the country and had great leadership with Rick Dahl, their CIO, and Gary Findley, their executive director, both of whom were very instrumental in helping me form my investment acumen and thesis. And then I was fortunate enough when Empers posted the position. Now, they weren't paying a whole lot because we were the smallest system, and candidly, we didn't really have a great story to tell. But I was born and raised here in Jefferson City, Missouri. I had great references with the Mosier's team and another mentor of mine who was, Craig Houston at the public school retirement system in Piers. So I had a couple of very nice references and some limited experience in the public fund sector, but I think it's safe to say it was a little bit of a leap of faith that we could sit down and put a plan together that could really be helpful and transformational to get this ship righted and steered in the right direction.
Okay, you started in 2003, and then you hit the great financial crisis. What happened?
Yeah. So, I can touch on a little bit about the underperformance. I mean, I think our system wasn't that dissimilar than others. We weren't mismanaged. I just think we were unmanaged. These pension funds for years and years and years, if you take a step back, a lot of them were created post World War II when interest rates were higher and equity markets were strong. You had the Industrial Revolution, et cetera. Plain vanilla 60/40 portfolios worked just fine. You could put those together, and if you ran them efficiently, they got you a return, or you could assume they would get you a return that met the actuarial requirements for you to run a pension plan, to set aside money in advance that's helpful to pay those benefits longer term. That all started to change a little bit. And, our fund wasn't mismanaged in that sense. It was just unmanaged. We didn't have enough resources to it. So the first step was just identifying that. We had a board that identified the fact that a change was needed, and they had enough moxie to step up and say, okay, it's time for change. We need to do some things different. So you got to have a board that has buy-in to change. Sometimes change is tough for a lot of reasons. So the buy-in has to come from the top. So it worked. We early adopters of some of these alternative strategies. We were very early on to portable alpha with hedge funds, early on to private credit. We were early on with energy, back when energy was doing really, really well back in that time frame. So we were blessed to have some really good short-term results. And I'm talking from 2003 leading up to the financial crisis. And then you referenced what happened. Well, this was a massive learning curve for me. The board was very happy to see the progress up until the financial crisis, but a lot of times investment people get a little too much in the weeds, and we're guilty of this. And we do the best we can to simplify complicated investment structures, and we all love talking our business. And a lot of times the boards just want to hear good news. And they were happy, and we kind of got complacent in a sense that they kept looking at the clock going, "Hey, Larry, numbers look great. Can we wrap this up? Lunch is coming up at 12 o'clock. And, can we wrap this up in 20 minutes?" And I think we were guilty of that, of kind of taking it for granted. I'm probably going to butcher the quote, but there was the old Mike Tyson quote that everyone has a plan until you get punched in the face. And I think we had that plan, and then the financial crisis came, and we got punched in the face, and it really made us reconsider things. The board, I think rightfully so, had a lot of questions. They felt like they were under advised on the risks that we were putting in with all of these alternatives. And we really had to stop everything we were doing and do a restart, which was go back and re-educate everybody, explain why we reviewed every facet of the investment portfolio, re-underwrote that facet, and decided if it still had a role in the portfolio going forward. As part of that, I really thought I came into the office every day thinking I might get fired for about a 3-year period. And it turns out our consultant got fired, and we changed some consultants and we made some tweaks in the portfolio. I ended up being a survivor of that group. And I think that adversity leads to strength at times. And, it really did help sharpen your edge a little bit. And it'll always make you appreciate that you need to do your education up front with your board. And communication is critical, because when you go through bouts like we did in the financial crisis, you can lose years of trust overnight. And it just takes years and years and years to rebuild that trust. And that's effectively what we had to do back after the financial crisis, was rebuild that trust, step by step. Um, and fortunately, we didn't make any big whole scale changes. We didn't turn everything on its head and unwind a lot of the good things we had started. And the board stuck with the strategy that we had that I think was very important and mission critical for us to see the success that we had the following 10 years.
So, when did you reach that point where you knew you had the board's trust again? Was there another episode?
Oh my gosh. It goes in fits and starts. I would say realistically, and I am not kidding when I say this, it was probably in the last year or two. For this reason, you can tell a board and tell the legislature that you're doing a good job. But until they really see the net result, which is contribution rates coming down, it's hard for them to really trust that, yeah, you're showing me on paper that we're doing better, but we're still paying 58 cents on the dollar to this pension fund for every dollar we spend in payroll. And that is painful for the DOT and the Highway Patrol. And I really do think it has just been the last couple years when we've been able to let that we fully funded a budget stabilization reserve. It's called a contribution reserve fund, and rates have finally started coming down in a meaningful way. And it wasn't really until that time that I think the board really saw that it's working. And sometimes you need that aha moment. You know, you can tell them all day long, it's working. But if they're still paying egregious amounts to these pension funds. They just don't see it. It hasn't hit the pocketbook yet. So it's a little bit of a show me state mentality. You know, I'm born and raised in Missouri, and you can tell me you're doing good, and you can tell me things are on the right path, but until you show me that our contribution rates are coming down and we see the progress, it's really what I like about that is a culture in Missouri that I'm very proud to be a part of. It is the show me state, and we don't like to just, it's a little more of the trust but verify. You need that verification at the end. And ultimately, I think it was that contribution rate coming down that finally got us over the hump with everybody.
You also reduced the risk in a significant way. Can you tell me what you took out in order to make that smooth in your portfolio and also be able to be opportunistic about earning those nice returns?
I think the first thing with risk is risk takes on a whole different definition based on who you ask, right? So financial complexity in my mind isn't necessarily risk. You know, that's what we studied and went to school and what we're proud to administer here. But to board members that don't live and breathe this, complexity is a real risk. So it just depends on how you define risk. And we define risk as way of things you can measure. And so if you're defining risk in terms of standard deviation, volatility of returns, we can absolutely check the box that states that we have reduced risk at the fund. And you know, there's a lot of there are naysayers out there, which I will acknowledge the other side. A big part of the diversification you get with alternatives is just the valuation metrics. When you value something once a quarter versus every day, undoubtedly that's going to lead to lower volatility. And that's part of it. It is somewhat masking volatility, but it's part of the overall strategy. The private markets have got more levers to pull and more ways to drive value creation other than hiring an equity manager who can just buy, sell, or hold stocks. So it's a bit of a leap of faith. I think that goes back to when you get that buy-in with the board. But the real thing we added was a lot of alternatives back in 2003. There was a focus on alternatives, and not just because on paper they made sense, but if you really look and go back to asset liability hedging, you know, our liabilities are long term in nature. And the less you can have variability in your investment performance returns, so the lower volatility of your investment returns, the lower volatility you have with your contributions as well. This goes back to the only two forms of funds that a system can get is either contributions or investment income. And if your investment income is less volatile, your contributions are less volatile. And we're already asking our employers to do an awful lot. And lowering the volatility of those contributions, even though they were very high, they weren't volatile. They were just pegged at very high levels. The last thing we wanted to do is have to go back to them and say they're going to go up from these here. So we included a lot of alternatives that did lower the risk profile, but you asked about giving us the ability to be tactical. Well, that goes back to the governance models and policies we put in place. You know, the board sets a broad policy target of which I am held accountable towards, but they give you a long leash. You know, we're plus or minus 7.5% of any targeted range. So if our target to public equity is 40%, we can go all the way to 47.5, or I can go all the way down to 32.5. Same way with fixed income. Our traditional fixed income is 22.5 target. I can go to 30 or down to 15. That's a lot. It's a lot of flexibility for the CIO to administer the portfolio and take advantage of views that you have on the markets. And that part, say what you want, different people. Some people don't want that risk. They would rather the board make that decision as to where those risks are, and they want that variability to be in their policy benchmark. I've always been very comfortable with when I see an opportunity of taking the risk. I've always had a belief that most of the time diversification is very, very critical, but I would say 90+% of the funds in our business are over diversified. We end up we have great ideas and they don't oftentimes make a big enough impact on the portfolio as they should. And oftentimes people are a little reluctant to take that outsized positioning or active management risk, and that's really never been a fear of mine. I've always been very willing to put your money where your mouth is and make that conscious decision, overweight, underweight, new strategy, whatever it may have been.
Let's get into the weeds a little bit. Let's get into some of the strategies that you did
All right.
employ. In 2025, you made kind of a big move into fixed income. What'd you do?
Yeah, our fixed income. I came from the state treasurer's office, where it was primarily a pretty plain vanilla fixed income management, cash management function. But I cut my teeth in fixed income growing up in education. So we have long managed our portfolio internally. And that ultimately rolls up to me. And so a big part of my day-to-day job is talking to the street and hearing opportunities on the fixed income market. And for a long, long time, we were at the very, very bottom end of our ranges with fixed income. It just when treasury yields were very low, the 10-year was sitting at 1.5%. It didn't make a lot of sense. When you're trying to get to a 6.5, 7% return, if you're only getting 1% on 20% of your portfolio, you got to find another 20% of the portfolio that's getting 13, 15% to offset that. And we just didn't have that many opportunities. So we underweighted it the best we could. But the last few years with COVID and the amount of money that was thrown around with stimulus, interest rates have gone higher, inflation has spiked. And 2025, we saw a unique opportunity with, government guaranteed mortgage bonds, and specifically the very last cash flows of these government guarantees. You're talking Fannies and Freddies and Ginnie Mae's, et cetera, where we could buy these long duration tranches at yields that met or exceeded our actuarial return target of 6.5%. And I literally walked into our board and said, the risk of me doing this is that we're early. They may go to 8%, at which point we'll have some losses, but we're going to keep buying more because if in a simplistic view, if the government is going to provide government guaranteed bonds that meet or exceed our actuarial hurdle, we as CIOs are not doing our duty if we're not looking at that and saying this has a home in our portfolio. If you can do things without the complexity and black box hedge fund structures and complicated natures of portable alpha and everything, we owe it to our board and we owe it to our constituents that simpler can be really good at times. So we effectively, backed up the truck and loaded up as many of these bonds as I thought we could stomach in the portfolio. And then we bought upwards of $1 billion in 2025 and redid our internal fixed income portfolio, added duration, just kind of turned it upside down. And I think those are the types of trades that we look at are more um, strategic in nature that, I don't look at that as a tactical. We haven't sold a single bond of those. They're well in the money, but we just put those in the portfolio and they will clip coupons and earn that return for us for a long, long time and provides a very good anchor to windward when times when maybe there's volatility in the markets and everything else is under stress. Those are the assets you want to be doing really well in that environment to complicate the other or to complement the other growth strategies that you've got that go in and out of favor.
You also have certain strategies when it comes to real estate investments.
Yeah, yeah,
You're known to still chase deals.
very much. Yeah, I'm probably a little unique. It's maybe the small town kid in me. I've always been more of a deal guy. We obviously studied in portfolio management and how those all fit in, but I've always been more of a bottom up deal CIO by nature,
Love it.
right? I let the deals sometimes drive the allocation a lot more than a lot of my fellow CIOs, which has worked out pretty well for us. I do think there's I chuckle. I like to make fun of Jefferson City. It's a small town, but it's my home. It's where I'm born and raised. But I'm also the first to admit that we don't have the monopoly on brains in Jefferson City, Missouri, and that you don't really get new great ideas by sitting in the office in Jefferson City. You need to go get your hands dirty and go see what's going on around the rest of the world and see where opportunities exist. So yeah, we had real estate. I cut my teeth in fixed income, but my major and background in college was also in, I had a finance degree, but I also had a real estate degree. And
Nice.
even my wife of 30 plus years gives me a hard time because we were buying houses on courthouse steps right after I graduated college and redoing them. So I always had this real estate passion. And of late, we didn't like the core markets with interest rates where they were heading. They just felt like the core real estate markets were a little toppy. The office market in particular, everybody knows the woes and the challenges in the office market post COVID. And we were lucky enough to get most of our money out of the core managers that we had shortly after COVID hit. And I was early, which a lot of times I am. But then the last couple of years, that's paid off because we didn't have the exposure to the core real estate market when it was going through its kind of repricing. But what we did focus on was an out of favor sector in there, which was retail. And we kind of termed it essential service retail. And you saw with the rebound in the economy and especially the service retail element. And what I'm saying there, food and beverage and hair salons and beauty salons and even the your national chains that have your cell phone services and a lot of food and beverage and those things, these little small strip malls. And think about your hometown when you go to a corner of Main and Main and there's a little shopping center that is always fully occupied. When there's a vacancy, someone backfills it right away. No one really thinks of that as institutional. It's more deemed to be a high net worth strategy to go buy these small strip malls. But I always viewed, who defines institutional investing? Isn't it really defined by putting a process around it more so than how big the asset class is? And so we found a manager and we partnered with them and we really kind of developed that. And I think we're up to 15 or 16 different properties that we've acquired post COVID in that particular sector. And it has been very, very resilient. It stood up very well. There's a return premium you can clip over broader, say, grocery anchored retail, and the properties have stayed full. They're performing great, and we ultimately think we can package them up, bundle them, get some cap rate compression, and we'll lather, rinse, repeat that strategy into something else we find at the time.
Beautiful. What else can you take advantage of being so nimble?
I really think it's a part of everything we do. We've
What are you
from our
looking at?
Well, from our private equity portfolio, we tend to favor smaller, mid-sized buyouts where, there's a real entrepreneurial element to driving earnings growth as opposed to just financial leverage. I already mentioned the fixed income portfolio, the things we can buy in our fixed income portfolio that if you're a big institutional manager, you just can't get the depth or you don't want to take that outsized risk, that benchmarking risk. It rolls through with our equity, the fact that we do portable alpha and then we buy floating rate bonds that outperform the borrowing costs with the overlays. So we get a little bit of incremental return. We call it kind of a portable alpha light strategy that we manage internally. It goes into the way we look at our timber portfolio and agriculture portfolio. That was a pilot program that the board gave me a long leash to expand back in 2011, 2012, and it's 3% of the portfolio, but it's our best performing strategy over the last 10 years. So it's got its roots in everything we do, the flexibility, the small system. That's why I really think it was a good fit, me landing here. I've chuckled a little bit that I probably would have said the wrong thing or done the wrong thing if I went to work for a bigger pension fund. I would have done something wrong and may not have lasted as long as I did here, just because it's a smaller fund and it lets me take advantage of my skill set a little better.
Of course, you're showing your humility here. That's part of Missouri as well. So, okay, let's get into the weeds on that because you have a special knowledge set having come from a farming background.
Yeah,
So,
yeah.
so kind of lead me through that and how that affected some of the investments that you made and what you're seeing in the market.
Yeah, I mean, I was born on small farm. I still live on that farm where I was born and raised, actually. And my grandfather went through the depression. We had a dairy farm at the time. Then the regulations became too intense, so he switched over to cattle, and it was more of a cow calf operation. So I was born and raised on a farm, and we appreciated every nickel that you made. We were, when you look back on things, a lot of farmers are land rich and cash poor. And I don't know if we were land rich either, but were certainly cash poor. And I think that humility and conservative nature was just instilled in me from birth. And you've seen, from working on the farm, I was driving a tractor, putting up hay bales when I was 8 years old, and that kind of work ethic and the conservativeness that you've seen a lot. I mean, if we had a bad year in cattle prices, we ate a lot more potato soup than we did, beef for dinner. We just you didn't you felt it and you adjusted it. We grew everything on the farm. I remember one of the few things we did was mom would take me and, you know, buy bread. For some reason, she didn't make bread. She made everything else, but she never made bread. So we'd go down. Of course, we'd have to get the day old bread at the bread store, and but just about everything else, we made off the we lived off the farm, and so when I started hearing these sales pitches from people paying $15,000 an acre for irrigated farmland land, I just kind of ran them out of the office. I'm like, there's no way you can make money on these things. I mean, I've seen it firsthand, and I know people will argue the other side of that. There's certainly been people that do it, but it's just a very different trade than what I am comfortable with. So, yes, I've got some unique strategies or unique experience there. And it has led me to kind of position. We had this timberland and agriculture strategy. For a long, long time, it was more timberland only. But of late, we've seen more opportunities with these multi generational farms that this next generation doesn't want the farm. They're tired of hearing their grandpa and their father tell them that our farm is worth 20 or $30 million when they're living like poverty with the way they are because the farm doesn't generate any income. So it's that same adage where they're land rich, but they're cash poor. And you're seeing more and more of these small, mid-sized farming operations that just don't have another generation to pass over the legacy to. And it's it's probably not that popular in certain areas, but we will go in and we will buy these things and we'll reposition them. Sometimes it's shrink the farming and the ranch to a level that's more of suitable to a hobby farmer who doesn't really care if they're making money or not. It's a lifestyle function because that is very much something I still appreciate. There is an element to just getting out and working the cattle and being out on a farm and working under stars, and that part I can certainly understand, but you got to cater those situations to that audience. So if you buy a 5,000 acre ranch, maybe you sell some parcels around it that have higher and better use for something else. Maybe it's road frontage for housing. Maybe there's a stream and some water resources that you can develop there that haven't been exploited yet. And then you keep the ranch intact, but maybe on a smaller scale for somebody to just run it more as a hobby farm. So we're doing those things. It's like a lot of things, farming, timberland, real estate. They'll get you so much passively, but to the extent you can modify your strategy and incorporate some new value add strategies and formulas into it, that helps move the needle and take a average performing investment into a top decile performing investment. So we take a lot of pride in being hands-on, getting our hands dirty, jumping into the trivial details on these deals and seeing if we can find ways to drive returns higher. Very much to your point, deal focused, which makes it hard. I mean, there is a challenge with that because we get stretched very, very wide and very, very shallow at times. You get to be a mile wide and an inch deep, and that's a challenge in and of itself.
What do you do in that situation?
I try to hire help the best we can, and it's tougher because again, going back to the small town, growing up family oriented. I mean, my if we couldn't get a family person to do it, you never really wanted to hire anybody, So you've always got this natural conservative DNA that says you got to do it yourself, and sometimes you got to acknowledge that you can't. And that's probably been one of my biggest challenges as I go through the system and the maturity of our team is one of the harder things for me to do is to delegate because I've had my hand involved in every single facet of this portfolio for 22 years and it's really tough to turn that over, but you got to recognize that point, and you got to realize it's time to pass the baton to a team. We've built such a good team of people here that I'm just happy for the success, and I'm happy to turn it over to them here in the coming years.
Coming years?
Yeah, I'm about I'm officially 18 months left of my final term as CIO, and then I have full intentions to take a step back and turn it over to somebody else to run going forward.
Wow. Wow. Okay. Congratulations on such an
Thank you.
amazing run.
Thank you.
You mentioned water a few times, having a stream on the property, buying land that's not naturally irrigated for, what was it, 15,000 an acre. You are very aware of water and resources around it. Can you tell us how you think that's going to affect investors in the future?
Absolutely. I might need to think a second here to formulate the thought, but water has always been critical. I mean, if you just, I hate to go back to my small town roots, but anytime you look at a piece of ground, it's always worth more when it's by water, whether it's a lake, whether it's river, it just always, that amenity has always been valued from a real estate perspective, no matter where you go. So, first and foremost, that hasn't changed. But I think what's really changed is the AI growth, the data centers, and water rights in general, I think. And I'm going to be the first to admit that I don't know how this is all going to unfold, other than I know that it's going to be more and more critically important going forward because we're going to need a lot more energy and a lot more power to fuel all these new strategies that are driven by AI. And we're going to need a lot more cooling capacity, and a lot of that's going to come from water and just how we handle that and deal with these water rights, that's one element of it. Obviously you've got the traditional water rights where people west when the water's flowing here, that's always been a battle. We're hiring consultants and engineers to help us get our hands around that because I do think that's another part of the agriculture strategy where if you can find areas that have additional water rights tied into them, that is an area that you could be able to take advantage of and exploit and help drive that performance from average to superior going forward. So that's a short answer. I don't know if you want to go into any deeper detail into anything, but
Sure.
water is going to become very important.
We have a lot of farmland around the United States, but in your experience, in your opinion, where are some of the more fertile areas that perhaps we should be focusing on?
Yeah, yeah. I hope you don't get me in trouble with this question, but I mean, if I were king for a day or president for a day, I would love to get the Congress together and take a fresh look at how we look at ag land across the country. We in northern Missouri, and you look at the fields in Iowa and Nebraska and all the Midwest are some of the most fertile grounds in America. And we've got government programs that literally pay you not to plant. The CRP programs, and you take them out of production. And then when you travel out west, you see the billions and billions of dollars that are spent on infrastructure to force water out of these beautiful rivers and into these valleys that are very poor soils. Yet we're deflecting water in some of the most beautiful mountainous regions in America to put water on places that really shouldn't be growing anything. They should be used for something else, and yet we're telling people in the Midwest not to plant. It's an inconsistency, and I get it. If you're a local state senator or rep in your area and you represent farmers and they want to protect that, I get it. It's 100% politics. But at some point, I think there needs to be a review of this on a national scope. And we could forget about us being state by state, but just think about us being Americans, if you want to use that analogy, and just start thinking of the best ways to be productive for Americans in general. And it may be a change of use for certain states and others, but I think it would be a productive exercise. It's a very pie in the sky idea. I know it'll never happen, but I am opinionated on that side. And it is frustrating to just see that as you go around the country, the inconsistent ways that we handle resources.
So, does that mean in the future you'll be changing up your portfolio at all? Can we talk about changes that you're making to this economy?
Yeah, we just actually came off of an asset liability study. We do those every 5 years. We didn't really see anything significant enough to make us change the portfolio significantly. The one thing I would point to are interest rates. If rates continue to rise where they're at, in particular, I would urge everyone, duration is the best hedge for the liability on these pension systems. And if you can get long duration, government guaranteed bonds, sort of like what we did with the mortgage trade in 2025. But, as we sit here this morning, the 30-year treasury is above 4.9%. That's not a terrible return for just straight treasury obligations. And if our message to the board was, we don't see any immediate need for changing today, but if rates continue to rise, I would suspect that the market is going to give us an opportunity to simplify these portfolios. Less focus on closed-end funds. Private credit has been a darling over the last 12, dozen, 15 years, but I think that'll drop in significance if we can get, investment grade bonds trading at 7.5, 8% yields. That's a phenomenal opportunity. So if I've got a crystal ball and looking at how these policies are evolving, I think inflation's going to be around a little longer. So I like our real estate. I like our broader real asset strategies. I think fixed income has got a much bigger seat at the table relative to what it had 10 years ago. A lot of what you saw with pension funds post financial crisis when rates were dropping were people solving for that low interest rate environment and reaching to alternative asset strategies. Well, have you really seen them unwind any of that trade right now with rates going back up? I think we're at the early innings of that. And I think if rates stay higher and inflation stays higher for longer, you're going to see a lot more of these pension funds de-risking and going back to traditional fixed income as a way, is a very good complement for the other growth strategies that you've got existing in the portfolio, whether that's private equity, hedge funds to a certain extent. Yeah, whatever it might be.
And what is something people often misunderstand about what you do?
Wow. I would have probably the relationship side of what we deal with I chuckled earlier about, private equity. Sometimes these strategies are 20 years, you've I chuckle. I've got a couple buddies they're on their third marriages in the time that we've still been with one private equity manager. So the managing those relationships with the GPs, and I've always loved that element of what we do because that's hard to quantify. You can see the numbers at the end of the day, but I take a lot of pride. We've got a handful of relationships that I would like to think we are their first call when they find something. They know us intimately well and they know it's a good fit, and they will reach out to us before they reach out to anybody else and say, "Hey, we got an idea that I think fits you really well." And you don't get that overnight with people. That is a longer term relationship strategy that just culminates over years and years, and it's not easy to do. And that part is often, a lot of people think and we are, we're quant geeks, we're math geeks. We sit back here and look at complicated spreadsheets and dissect trends and analysis and things. That's part of what we do. But the behind the scene thing is the relationships that we have to maintain and establish as part of our day-to-day jobs.
Interesting. So, who is Larry outside of work?
Gosh.
What do you do?
Well,
What are your hobbies?
I can't turn the brain off of investing. I, I've been investing in real estate personally for a long, long time. I've got several little individual deals that I've put together out in Montana is one of my favorite places to go hang out. It's just a beautiful state and a beautiful area with the mountains, and there's a simplicity out there that I really enjoy. I grew up hunting and fishing. I've gotten away from hunting a little bit. I still enjoy fishing. Got to be pretty good at golf. So I still play a fair amount of golf and can be competitive most of the time. But other than that, my daughter was blessed us last year with a grandson, so I'm officially a grandpa, and he's 1 year
Oh,
old, and it's been life changing to spend time with him, and just again that simplicity is a underrated term with what we deal with day in and day out. We got complexity checked. We got a lot of stuff that requires a lot of overtime to figure out what we're doing. And sometimes, just going and playing with a 1 year old grandson or getting out and wetting a line in a fishing boat and hanging out with buddies, that's hard to beat. So that's whether it's on a golf course or a fishing boat or chasing a deal with somebody, or hanging out with the grandson. Those are probably my favorite pastimes now.
it sounds like you're ready for retirement in 18 months.
Yeah. Well, it won't I won't be completely gone. I'll hang around, but it's time for me to step down and maybe focus more on the deals a little bit and stick around for a transitionary period and just start a new chapter somewhere else.
Scale of 1 to 10, Larry. How much do you love chasing deals?
Oh gosh, can it 10 and a half? It's just what motivates me. It's kind of crazy. I literally just got back from 2 weeks on the road and we're working a few new deals that we closed on and just brainstorming and thinking of ideas of what you can do with the strategy, visiting with local folks, understanding what tools you have to work with in order to implement your strategy. And then after 2 weeks away from home, this was nonstop, and I'm ready to get home. And then I spent the weekend here, and it's absolutely freezing cold and 30-mile-an-hour winds. And I'm one day back, and I'm ready to get back on the road. I just feel like I do better when I'm outside the office, and I'm a lot more productive. But it's always a little tough catching up. But that's that's my passion. That's what I love to do.
For sure. What kind of deals? Mostly real estate?
Yeah, it's always real estate with me. You go back to the origins of time and landlords, and it's just a proven strategy that just works. And they're not making any more of it. There's always uniqueness to it. AI can't displace this strategy in my mind. They're not going to ever solve the human element about finding niche opportunities that you can take advantage of. I think that's just one of the few areas that AI can never touch. I don't know if you can do a lot of things wrong in real estate and still get your money back out. And that's what I like about it. The downside protection is just covered more so than a lot of the other strategies that we do.
Your timber investments have been pretty good for your fund. So
They've been great. It was ironically that was the one you mentioned that we were predominantly a 60/40 portfolio, which is 100% true. Maybe I shouldn't say 100% true, 97% true, because we had a 3% allocation to timber when I started in 2003. And the board, I don't mind saying this, the board probably got sold on a bad strategy at the time. It was more of a green field, we'll plant the trees, biological growth of a tree strategy, and it just didn't work. So I spent the first 5 years here trying to figure out ways to get out of it, which I really couldn't. We sold a few assets that I thought needed to be sold. Financial crisis hit. I just put it to the back burner because what we were doing was selling timber to the housing market, which just completely collapsed overnight almost in the financial crisis. That strategy went down 50%. And we just had bigger fish to fry and focused on other more pressing issues in the portfolio. And then when we ironically picked it back up, it was 2010, 2011, and we started looking at how depressed land values had become across the Southeast in particular. And then we migrated out west eventually. And we kind of did a 180 and changed the strategy and again, this was a pilot program that the board gave me a long leash on to go try out. And 10 years later, it's our best performing strategy. It's outperformed private equity over the last 5 and 10 years. And we've really kind of developed a
nice.
niche out west, and it's been one that has been a lot of fun along the way. It just fits me, it fits my profile very well, and I'm just so lucky that the board was trustworthy enough to give you these opportunities because it all goes back to it. It all starts with governance. If you got a great idea, but your governance model doesn't allow your staff to implement it and put it to use in the portfolio, then it's not really worth much. You have to empower good people with tools and resources and give them a long enough runway to go do the job. And my experience is good things happen when you hire good people, you put a good portfolio together, you put good policies around them, performance generally follows.
And was there anything extraordinary about these timber investments that you did make?
Candidly, I think we got pretty lucky with COVID. A lot of these things, we have really good relationships and sourced some really unique properties. A lot of them were in Montana, I'll open to admit. And then COVID hit, and you know what happened with COVID, and it really expedited the remote work environment. I think we were going there naturally, but COVID just fast forwarded that market seemingly overnight, which might have taken another 10 years to get there. So people started realizing that oh my gosh, I live on the West Coast, but I don't need to live in the West Coast in these dense urban areas right now. I can work remotely from Montana and it's beautiful out here as long as I got an internet connection. And that market just took off along with a lot of other rural markets. We've got a great portfolio in Tennessee. It's about an hour and a half outside of Nashville. And, it's in more of a recreational area. It's absolutely beautiful. Those types of markets, the Montanas, the rural Tennessees, they're beautiful places of America. And I think COVID really fast forwarded the recognition of those properties for us, and we just never could have modeled the returns that we got from those. And you got a nice spike with we got a lot of white oak on these properties. The bourbon craze that went crazy when everyone wants bourbon, it has to come from white oak barrels. We were beneficiaries of that. We were selling white oak trees into all of that hot market. So I'd like to say it was 100% skill, but we found some good deals and some great properties. But then, like a lot of things, we got a little lucky with our timing. And with COVID, it's just been a boom for that particular strategy.
Okay. So, last question. How are you setting your team up for succession?
No, it's a great question, and I'm proud and anxious to tell that story a little bit. It takes time. You know, you we've I've created a head of public markets on our team, a head of private markets on our team, with the expectation that those would be our internal candidates to succeed for the CIO position. I assume the board and our executive director will take a more of a nationwide search. I think they'd be, kind of foolish not to look out to see who else might be interested. But I think we've got two really good, strong candidates internally for the job. We've added a bench. The board several years ago, we identified the need for investment staffing. And we always had a senior team, but we never had a bench that we were developing underneath that senior team. And I think you have to get comfortable with turnover in the public funds sector, and you always need to be grooming a bench to help the senior team because you're inevitably going to have turnover with that senior team. And I think we've done a really good job for a long, long time. It was just two of us here at the organization, and we're up to 8 people now, and it's just they all have a reason to be in Jefferson City. They appreciate the culture. They're either local here or want to be here for another reason. And we've just got a great team, and it takes a long time. I first thought we didn't need to take this time, but this is a strategy that we started about a year ago, knowing that I was going to take a step down in several years. And I was skeptical at first, but I'm really starting to see the value of it. And part of it is me. It forces me to do what we talked about earlier, which is to delegate those duties and start letting go, because the board and your executive director need that confidence to see that the system can run with you not in the seat. They, right or wrong, most of the people here don't know our investment portfolio but for me being in this seat. And they need to know that they can remove me from this seat and it's going to be just fine. So that process is a little bit of that trust building exercise. It takes time to put in place. And I think we've got a great strategy. And I think, candidly, I think the system's never been in a better place, and just thrilled to be able to leave it in a better place than where we found it.
Well, congratulations. And thank you so much for your time today. It's been wonderful. This is
Absolutely.
Larry Krummen, Chief Investment Officer of Missouri DOT and Patrol Retirement System. It's been a real pleasure, and very much looking forward to celebrating your Hall of Fame at our event in Kansas City, Missouri, coming up in March. Thanks,
Thank you,
Larry.
Christine. I'm humbled. Thank you very much.
Thank you.